Hey everyone, I think we have a pretty great panel here. So I'm head of ecosystem at Bima. If you don't know Bima, it's over-collateralized CDP where you use Bitcoin as a collateral to mint stable and use it further for generation of yield. So both institution and retail are our clients. But now I will pass more important guys to introduce themselves and their protocol. So maybe starting off from you, Sophia.
Hello, my name is Sophia. I'm the head of DeFi for Kelp and also the head of DeFi for Kernel. We just launched restaking on BNB chain 6 months ago, got about $600 million in deposits. So not BTC space specifically, but we onboarded a lot of BTC asset issuers on BNB chain. And yeah, really great to be here.
Hi everyone, Lucia here, co-founder of Satlayer. We are building the new financial system on Bitcoin as the economic layer using restaking primitives. And we prioritize focusing on use cases where there's real yield, working with a lot of the biggest and best projects in the space across DeFi, RWAs, and institutional and sovereign adoption.
Hey everyone, my name is Ross and I'm co-founder of Stroom. We are building Bitcoin staking protocol with focus on Bitcoin native yield and also have like a liquid token on other DeFi ecosystems backed to Bitcoin, but with additional yield coming from Bitcoin sources.
Hello, my name is Filipe. I'm a lead contributor at Inception. We focus on providing meta LRTs on top of Symbiotic. And we do support currently LBTC restaking on Symbiotic, and we focus specifically on empowering multiple creators to ensure that shared security ecosystems remain sufficiently diverse in terms of curation so that it doesn't end up being compromised by a high level of concentration.
Hi everyone, my name is Nick. I'm the founder of Mellow, and we're building the institutional infrastructure for restaking, staking, and asset management.
Oh, thank you so much, guys, for short and sweet intro. Now, as we are talking about on Bitcoin staking and restaking, so people want yield. How exactly your products generate real yield? Maybe we can start off from Nick itself.
Yeah, so we're basically looking into different assets and different use cases. And right now, we recently started launching interoperability vaults that can basically work on any EVMs and they can accept any assets. And I think that's it's very important to have good diversity in terms of assets that we use for restaking, just to mitigate volatility, also to get like better diversity in terms of composition for securing the networks. So yeah.
Like you're doing for USBD.
Yeah, of course.
You can.
Yeah, so we think like one of the largest sources of potentially for Bitcoin will come from shared security. So there is obviously different setups with Babylon that accept native BTC, Symbiotic accepts any token, so it can be any representation of BTC that can be used to provide shared security for networks. And yeah, we think that shared security is also composable with other more native yield streams of BTC. So you can compose Babylon rewards on top of native BTC through Lombard BTC being restaked on Symbiotic to have more rewards, but it will also hypothetically be Lightning rewards from, for example, Stroom's upcoming product with BTC LST that you could hypothetically restake it on a Gonçalves or a Symbiotic to have additional rewards on top of it. So yeah, shared security is definitely going to be, in our opinion, a very important reward stream for BTC.
Yeah, from yield generation perspective, we focused more on Bitcoin side infrastructure. For example, on Lightning Network, it's organically grown and most adopted Bitcoin scaling solution. So it's like a scale to billions of transactions at the moment, and it's possible to put Bitcoins and generate rewards in BTC by routing of the transactions. Also, we plan to use our liquidity in BTC across different Bitcoin Moderators and BitVM projects. And like for us, it's very important to generate yield on Bitcoins in the same currency and help to grow the economy on Bitcoin ecosystem.
Yeah, I think from our perspective as the leading Bitcoin restaking protocol, we've really taken it upon ourselves to really define, this, potentially previously scary question of where does the yield actually come from. And so for us, we've been pushing on some, I think, very straightforward use cases that I literally give the same explanation, whether it's for crypto natives or for TradFi. One big use case is actually insurance. Because if you think about restaking and the mechanisms, it actually operates very similar to an insurance fund, right? Where the slashing is basically the insurance kind of payout, and then the restaking yield comes from the insurance premiums, and then the kind of restake Bitcoin, the vault is the insurance fund. And so insurance is actually quite an interesting structured product where you can do a lot of things. And so for us, some of the first use cases that we're working on is basically providing insurance / being a backstop for lending protocols. This is super interesting because not only does it directly drive more users, more TVL, more loans for the lending protocol, it's also one of the missing pieces in unlocking under-collateralized lending / credit, right? Kind of one of the holy grails of crypto and DeFi. In addition, insurance, we can use the same kind of mechanisms for perp dexes like Hyperliquid, and we can also offer slashing insurance, not just for restaking protocols, but even for staking in general. And so this, I think is super compelling to a lot of the capital allocators, right? And kind of the LPs in the space where, especially on the Bitcoin side, they're extremely concerned about not risking the principal, right? They're okay giving up more yield in exchange for principal protection. And so I think this is going to be a very compelling product where the yield is just the insurance premium that either the protocol pays or the LP pays that's now paid out to the restakers. The second kind of big use case for us is really around the concept of providing faster liquidity. So this very simple example is think about payday loans, right? And since the history of finance, everyone has always been willing to pay a premium for getting faster liquidity, two things. And so because we have all this restake Bitcoin that we can tap, right? That essentially is the best programmable asset, best programmable collateral in this space. We can do interesting use cases like this. So some of the use cases here would be, for a lot of the more kind of trading side of use cases, for cross-margining, for arbitrage, right, Sex versus DEX. Essentially, what this allows is providing them the asset in a much faster time frame, and then kind of the restake Bitcoin vault waiting for the actual final confirmation in exchange for a premium, right? So that's, again, where the restaking yield comes from. And so there's a ton of use cases in addition to this. For example, we could even abstract away bridging, right? By kind of being this layer that it offers sub-minute bridging of assets, right? And then the kind of restake Bitcoin vault will actually wait for the bridging to actually confirm. So these are some of the bigger use cases that we're working on with a lot of, I think, kind of blue chip protocols in this space. So recently we announced our partnership with Redstone as well as Plume, and there will be another one tonight and a lot more next week. So very happy to share all this with you guys.
Amazing, that sounds like lots of new developments. On the Kelp side, so there's really three ways that we have yield. One is basically through the restaking APR that we have right now, which is currently sitting at around 3.4%. So that's the staking yield that we get from Beacon Chain and then the rewards that we get from AVSs. Currently, we're only getting rewards from EigenDA, which issues out Eigen, which we reinfuse back into our restaking APR. Now, that kind of leads me to the third point. Most of our TVL comes from the yield that users are able to get through lending, specifically looping. So where it gets very interesting, right, is essentially when you have a higher restaking APR, you're able to better borrow Steve, WETH, and then that looping APR becomes interesting if our restaking APR is elevated. I think it's going to get even more interesting once we're going to start getting more rewards from AVSs, so that native APR can go up to 5%, and that's basically double the yield from what users get right now. Kelp, by the way, is on most of the prominent lending markets, like actually all lending markets, Aave, Spark, Compound, Morpho. So You want me to stop? Yeah, so these are the 3 sources of yield that we have.
Yeah, I mean, I will just say, keep it short, guys. But yeah, I think when it comes to kelp versus kernel, if you mind give a brief to users, that would be helpful.
Yeah. So 2 separate companies. So kelp is essentially an LRT that's built on EigenLayer. We're exploring soon to be on Symbiotic as well. Kernel is a restaking infrastructure that's built on BNB chain. So they're 2 completely separate products. Kelp has been around for the past 1.5 years. Kernel just launched about 6 months ago. So you can think about Kernel actually as the EigenLayer of BNB chain. So far right now, we've only been taking deposits, 600 million to date since we opened up those contracts back in January. Second step is onboarding operators. We've already signed 17 AVSs, which we're calling DVNs. So looks like we're going to be going fully live, hopefully end of this year.
Interesting, makes sense. I think now we had a word around restaking, staking, but okay, points only yield. Does it make sense to you? Or we should look for more real world yield? Okay, I mean, even in Symbiotic or like Satlayer, even like Luke mentioned about the insurance, so whenever slashing happens, insurance makes sense. So what's your opinion about this?
Yeah, I think like points is not something that you can trade or do something with it, and of course the real yield makes sense. And I also think that we potentially should expand it outside of the crypto ecosystem, because basically I fully agree that restaking is basically its insurance mechanism. And it's very important to understand this. So it can be also utilized for TradFi use cases. We can get yield from there. And broadly speaking, it's not only about insurance, it's basically about any use case where you need lots of idle capital. And this is like capital that is idle most of the time. So it can be project financing, it can be factoring, and other use cases like this. So I think that longer term, as soon as we will see more transition on the fintech side into crypto, there will be just much more real use cases, and there will be more real yield. And from what I see right now, already fintechs, they are starting using crypto rails, they are starting building their own wallets with account abstraction. Later, I think we'll see some roll-ups probably, because they also need to comply with the regulations, and this will help, and also they will be getting sequencer fees. And at the same time, restaking deployed on those CVMs or working through interoperability from Ethereum, it will be the case where they can use it for insurance and other use cases.
Yeah, I think the points, even though there is some people that might be less excited about it, I think it just depends a bit on the risk appetite for every people, but it also builds other DeFi use cases. You may argue that if points were not here, maybe Pendle will be struggling a little bit more, you know, because the use cases of yield tokenization is mostly when there is a yield volatility. Not so many assets have volatile yield, like definitely LST don't have very much volatile yield, right? And then you have a point, yield uncertainty. So points gives a yield uncertainty that people want to hedge them against themselves. And there is some people that prefer to buy a PT position at a discount, right? So not taking the points, but willing to buy the underlying asset at the discount. And you have other people, let's call them maybe gamblers, that want to actually buy the YT position and speculate on the value of the points. And you need to match both, so that there is some sort of risk hedging happening through those platforms. So if there wasn't any points, there will not be, you know, such a very important and prominent Pendle, for example, that's, you know, really gained a lot of traction since the point season started a while ago. Related to insurance, I think restaking is a way of insurance in itself. So whenever we want to somehow, if there is a slashing, let's try to find insurance. I think here is more a thematic of structuring, meaning that you need to match people that have different risk profiles, and I think here BTC can come into place. If there is a slashing event on Babylon and you have LBTC, you might be willing to give away half of your yield if you get insurance, but you will definitely not, the other part of the transaction will not be someone with BTC very likely, because he will have a risk profile similar than yours, because you should want all the yield, not only half of it. However, if the counterparty is a ETH-LRT degen, he might actually accept only half of the yield because he's usually not able to get that Babylon yield with his ETH, right? So it's more a thematic of structuring, I will say, and structure products in some way whenever we want some restakers to have some protection against certain type of slashing risks and try to sell that risk to other people that usually don't have access to that. But I don't think there is any platform at the moment that is able to, let's say, structure slashing events in a more customizable way, let's say.
Yeah, from builder perspective, I think that restaking in general is very good tool, and pointonomics as well, like to get traction for each protocol and to get first users, the first security, and so on. And yeah, so I think it's really beneficial for the whole ecosystem and new use cases on crypto. And from insurance perspective, I think this is also a good thing, because not all protocols can be like a secured and super trustless, but with these insurance mechanics, we receive like a new understanding of the security. So it can be fully less on technical things, but also it can be even stronger with these crypto guarantees, insurance pools, and crypto economic security. Yep.
Yeah, I think just to kind of add on to everything that was said here, I think it's yield is pretty interesting, and I think at the end of the day, that's probably what I would guess 3/4 of the room is probably here for, because I think especially for retail, right? People love yield. Definitely don't want to lose your principal, and then I think on the institutional side, they certainly care very much about kind of where does the yield come from, how does it work, and so I think the nice thing about kind of the Bitcoin ecosystem right now is that some of these protocols are already live in terms of the token, right? So Babylon's token is live, Solve's token is live, and so you are now getting a mix of of token and points. And so I think in general that's a nice mix where you have kind of some of the upside potential on the point side, right? Especially if you look at most protocols, right? Generally that first airdrop gives the highest APY in terms of effective yield. But at the same time, you have some liquid yield, right, in terms of actual tokens that you can actually then sell off if you need to, right? And so I think it's quite an interesting mix. And then in terms of where we sit, we are actually kind of the four-sided yield for kind of Bitcoin staking and restaking. And so you get kind of your LST of your choice, whether that's Solve, Lombard, Bedrock, right, or any of the other major LSTs. Then you get your Babylon yield. A lot of these L1s right now are incentivizing. So and some of the biggest chains, right, like Sui, like Solana very soon, Bearchain, and then after that you can get your points from Satlayer. And we mint receipt tokens, so you're able to then, if you want, completely optional, go downstream into kind of lending, looping, right, DEX LPs, etc. But I think in general, it's interesting to kind of have this mix of kind of best of both right now, and it's a pretty interesting time.
Yeah, I think y'all really gave some good answers. The only thing that I would add, given that we've also went through that points mania with Kelp, is that points are really for just bootstrapping and they're not an actual business model. And I think that's something that has probably negatively impacted the industry, where it's this big points frenzy. We've also engaged with many different layer 2s with our vaults. So we were actually one of the first vaults to specifically work with layer 2s and their points. So it's basically a points aggregator. We just parked our TVL on Linea, Scroll, Kerak, a few others, Swell, Hemi, in exchange for points for our users. So it's something I think that works well right now, but I absolutely don't think it's sustainable.
So I think restaking and staking is great, But what other use cases you see apart from security are there? Like, okay, security is there, like you are securing, let's say, we are securing like with USBD, couple of networks in Symbiotic. We'll do with other restaking platforms as well. But what do you feel, any other use cases you would love to share?
Yeah, I think it's a lot of use cases that can be covered, this mechanism, because like at the beginning it was mostly about securing consensus, and like the most common use cases, it's bridging, it's interoperability, it's sequencers, whatever. I think like the most interesting is it's the use cases that are coming from TradFi later and things that we discussed about insurance factoring and all that stuff. Also, inside DeFi, I think that there are lots of use cases where there could be specific ecosystems where you may need DPEG protection, you may need liquidation protection and things like that. So basically securing any economical mechanism, economical model, and especially principal protection for any DeFi protocols, and even smart contract risk. If we speak about this, so right now the mechanisms that we have in the ecosystem for smart contract risks for insurance, they're not capital efficient because basically have separate pools for every type of risk. And in this case, if you can keep the portfolio of insurance with a low correlation, then you can make it much more capital efficient. And to implement this also, it's not something very sophisticated because it's basically any use case where you can build an oracle that will observe some events, and in this case you can ensure it. It can be also optimistic oracle like UMA, or it can be even just some custom committee with some repeatable entities that will be doing same thing as oracle. And in this case, you can like triple or quadruple the yields coming from insurance, and this will become interesting for the LPs, because right now the price is just too high, and that's one of the reasons why only very big LPs use insurance for the smart contract risks, and they use it for very specific types of capital deployments, and usually for very short periods of time when there is some very high yield, and for example they want to put more capital than their risk model allows them. Then they buy the insurance and they can put more capital into a specific protocol.
Yeah, I think the use cases of shared security is really like enabling truly Web3 infrastructure decentralization. Because if you think about the oracles, interoperability, decentralized sequencer, decentralized RPC, and all that kind of stuff is economically not viable through a proof-of-stake system. Proof-of-stake system has shown that it is possible through maybe with layer ones, and then you started to use so many layer twos because they understand, you know, it's very difficult to just come up with a new token and secure, you know, your own L1 with your own token and so on. So when you're just doing decentralized indexing, it's definitely super difficult, and it just doesn't make sense in the economics. But with shared security, it makes it economically viable. So thanks to shared security, and I think the biggest use case that we will see in general is like true Web3 infrastructure that will be trust minimized and a much bigger scale than very specific players like Chainlink and you know, layer zeros and stuff like that, which, you know, some of them use a lot, you know, trusted node operators to ensure high performance, but you could ensure high performance through slashing if you must perform well, otherwise you get slashed, and then you enable truly going into the path of true decentralization for Web3 infrastructure. So in my opinion, I think that's the biggest like change maker that this is enabling, that is you know, needed also for the ecosystem. Otherwise, we will be relying more and more on trusted players for critical aspects of Web3.
Nothing to add.
I think for us, being in kind of the restaking trenches for the past year, we've kind of gone through that journey of initially looking at infrastructure, right? But I think the thing that we found with decentralization of infrastructure is that it is not the top priority for, I think, most teams in this space. The number one priority for app builders is performance of that infrastructure. And, you know, I think especially given just in part how new restaking as a primitive is, right? And I think how much of a way still some of this infrastructure has to go. A lot of times the centralized infrastructure actually performs better than the decentralized alternative, right? And as for any builder in this space, right, especially if you're building apps, like you already have your hands full just building your app. The last thing you want to worry about is like, do I want to have like a worse performing infrastructure that's more decentralized, or a better one that's centralized? I do think we'll get there in time, but I think right now, I think especially with some of the other restaking protocols that bet on infrastructure and EVM, which already has the most mature infrastructure in the space, I think that was a strategic mistake. And so that's why, in part, for us, we took a very differentiated approach in kind of figuring out the clear use cases more on the economic end of economic security, on the financial side of things, on the DeFi side of things, and then having that inform what infrastructure is truly missing so that there's a clear customer need for the decentralized infrastructure.
I think on the Kelp side, so over the last year, we've delegated over 600,000 ETH to eigenlayers to provide security for AVSs. As of right now, there's only one AVS that's actually issuing rewards. So I think it's wildly single-sided, the way that it works right now. And I think that's why there may be a lot of shareholders that are losing confidence in restaking, given that the infrastructure itself, like Eigenlayer or Symbiotic or Babylon, need to enforce the other mandate, which is that these AVSs need to provide rewards to users. So that's something that we've been pushing with the Eigen team. Obviously, if we want to continue to have support from our shareholders, basically restakers, then this is something that should come into effect. Slashing sounds like a very, just very scary. But there's not many events that are slashable, right? Like unless an operator's double signing or doing something that is as equally as fraudulent. But if it's just like downtime, it's not considered a slashable event unless it's a lot of downtime. But the idea is that over time, we will be working with AVSs that do have slashing. The interesting thing is that most AVSs that are thinking about having rewards are also going to be enforcing slashing as well. So there's the responsibility for the LRT itself to do its own risk management. So we currently do that in-house. Other competitors, for example, use Chaos Labs. So I think this is something that we're going to have to think about a bit more, and something that's going to be very relevant, or is already very relevant, actually.
Yeah, I think staking, restaking is great. And when it comes to Bitcoin, it's also pretty much great. Now let's zoom out and see, being a developer, without knowing anything, how he can build stuff while going even multi-chain. So what's your opinion around that?
Yeah, I think that going multi-chain is really important, and like right now, all the major...
Let's be quick, like we have few minutes only.
Yeah, sure. So I think that it's really important to go multi-chain, and also the major restaking protocols there on Ethereum L1. So, that's the reason why we also build the system with the interoperability for restaking. Basically, it's the vaults that can be deployed on L2s. And in this case, users can bring assets directly on L2 and get the receipt token there. So the liquidity is staying on the L2, and we mint IFTs that go into restaking on L1. And it's the native way to restake from L2s. So it's also the native way to restake governance tokens, and to secure the ecosystem with a mix of governance tokens and assets that ecosystems have there.
Yeah, about the omni-chain part, I think it's like more important for capturing additional TVL from DeFi composability, meaning that if there is a lot of ETH on Base, you should bridge, the LRT to Base, do looping, and as the TVL growth, it funnels through the shared security protocol. I think it might be less impactful to open the deposits, for example, of Symbiotic hypothetically on Base and multiple chains, because it's already widely available on Ethereum itself. So maybe there might be use cases where some governance tokens might be used for shared security, and those are only available on specific chains. But I think the most impactful is definitely, being able to bridge the LRT itself to other ecosystems so that you can do looping. And what Nick mentioned, I think, is also, I think it adds conveniency and also less operational risk in terms of, liquidations, or when performing the looping, it's also more convenient that you can just deposit in a vault on a L2.
Yeah, I agree with this use case for governance tokens as well, because like a paying for shared security, stakers can hold it and restake it, not like sell and make also like the position of protocol more sustainable as well. And yeah, so, and also connecting different chains and different ecosystems. I think this is like a super important for capital efficiency and like creating a lot of new use cases in DeFi as well.
From our perspective, we view it very much as more bringing Bitcoin, Bitcoin liquidity, and Bitcoin shared security to the rest of crypto, right? Because when you look at Bitcoin, the biggest asset in this space, in some ways it's actually ridiculous how in 2025, right, what is it? 17 years after the creation of Bitcoin, Bitcoin dominance is still over 60% in the space. And so I think, I don't think anyone in the room is probably willing to, challenge the fact that Bitcoin is kind of store of value, right, and is probably the best, is the best asset of all of crypto and potentially even in all of history. And so I think it's, then if you look at it from that lens, right, it's kind of shocking how little of Bitcoin is actually being deployed into DeFi and is being utilized as, kind of as an asset instead of just digital gold sitting idle. And so that's kind of very much what we are working on. And, I think it will be very interesting to see the growth of that, especially just given, kind of how strong Bitcoin remains and how it's probably, again, the only asset that is not only getting institutional adoption, but even sovereign adoption.
I think from my perspective, the question was more like advice to developers, right?
Yeah, that's good.
Yeah, I mean, I'm very bullish about like innovations that can come from AVSs, because what we've seen right now are sort of like very vanilla, just like case scenarios, roll-ups, data availability layers. There's a lot of innovation that can come, for example, from gaming, prediction markets, essentially like any sort of protocol that requires external validation. So I feel like we haven't seen the actual consumer side, right, of AVSs. I just feel like right now it's mainly infrastructure, which is like crazy to me that other protocols like are not actively thinking about doing this. But I think that's something that's gonna come in the next wave. I mean, obviously we have all the right primitives right now, but very excited to see developers building more consumer-oriented AVSs. Yeah.
Yeah, I think even I'm looking forward for those consumer-specific applications. I think we are end of the time, so I think, guys, if you want to know about more each of the protocol, follow our socials, follow each of us here, and stay tuned and restake. Thank you.